everyone tuning in, we are going to be talking about where venture capital is heading in the long term, which I think will be very therapeutic for all of us because this entire year has been a lot of reaction and not too much reflection. So I want to focus a lot on thinking big. We will address some of the hype and buzz of today's market, but focus a lot on what venture looks like, 10 years from now and what founders can do to make sure they're positioned to be the companies that exit and take up all the headlines like they are right now. So to do that, I have a panel of amazing people. I would love everyone to introduce themselves. And let's start with Gail. Let's everyone give kind of their background, 30 seconds, and kind of what stage they're investing in.
Thanks, Natasha. Excited to be here. Hi, guys. My name is Gail. I'm based out of Chicago, and I founded and run a firm called Vitalize. So we invest in pre-seed and seed stage business-to-business software focused on future of work and future of learning.
Awesome. Maybe Ryan, you can go next.
Hello, everyone. So grateful that I could be here with you all today. I see some familiar faces on the panel, and I'm excited to sit here and listen and learn. I am Ryan East, the founder and managing partner of Next Play Capital. We invest in other funds out of a fund-to-fund product. We're very fortunate. Charles Hudson, we have been able to invest in his fund. We are also have a direct investment program as well, and have been fortunate to invest in some great companies like ByteDance and Impossible Foods and Hippo Insurance and a number of other exciting companies. In a former life, I actually played in the NFL. And won a Super Bowl. And so I try to find my ways into great huddles with great people. Happy to be in this huddle today.
Awesome. Next, let's throw to Cheryl.
Everyone, grateful to be here as well. I'm Cheryl. I'm of venture growth and partnerships at Republic. We are a spin out of AngelList that allows anyone to invest in startups, accredited and non-accredited, and for startups to raise up to 5 million. And so we help pre-seed through Series C companies. We've helped over 250 companies raise over 150 million. Those stats, to be honest, are always outdated, so we need to get the new ones because we're growing so fast. We actually just completed a $36 million Series A, and we are hiring. So I was full-time employee number 10, and we're going to be to like close to 300 by year end. So very exciting stuff happening. One of our portfolio companies just raised from A16Z and a couple more up the pipe. So very excited to see that. Thank you, Natasha, for reporting on that.
Yeah, I think I heard about that company this morning.
Yeah, exactly. And so besides that, I'm also a scout for Lightspeed and investment partner of the Community Fund, which is a $5 million fund backed by Flybridge to focus on community-centric startups.
Perfect. Thanks, Cheryl. And then would love for Eric to go, and then Charles can finish it off.
All right. Thank you very much, Natasha. And it's also an honor to be here. Thanks to the organizers for inviting me as well. So I'm Eric Osiakwan, and I managing partner at Chanzo Capital. And Chanzo is an Africa-focused VC firm that runs two funds. Our first fund is the King Startup Fund, which is sort of doing pre-seed and seed investments. We've done a total of 16, 12 are still going, and that asset is probably around $50 million right now. And then our second fund is the King Scale-Up Fund, which focuses on Series A and Series B. We're in the process of raising first close in that fund, actually. We're still in that process. And we primarily focus on digitization within Africa. So the digital economy is emerging in Africa. So we look for entrepreneurs that are building that economy, and we back them. So fintech, e-commerce, the usual stuff. And then, there's 5 countries that we focus on, which are the Kings: Kenya, Ivory Coast, Nigeria, Ghana, and South Africa. We have Mauritius Domicile Fund for the Fund 1. We also have a U.S. office, and Fund 2 will most likely be a feeder from the U.S. into Mauritius. And we have an office here in Accra, where I am now, and also in Nairobi and Johannesburg.
Thanks, Eric. Charles, would love for you to finish it off.
Sure. Charles Hudson, managing partner, Precursor Ventures. We're a pre-seed focused fund based here in San Francisco. We'll make 30 to 40 investments per year into sort of pre-launch, pre-traction companies, early as we can find them. No real requirements in terms of traction, no real requirements in terms of sector. We're just trying to find great people as early as we possibly can.
Thanks, Charles. So just for everyone tuning in, because I saw a couple more people join, we are talking about where venture capital is heading over the long term. I think we should start with maybe level setting a little bit on what today is like, and then we can get into the bigger questions. Charles, I'll pick on you first, since you kind of mentioned what feels like the truth of a lot of pre-seed right now, which is anything is fair game, and there's a lot happening. And so maybe talk to me about how busy you are right now, and if you are expecting a summer that's going to be as busy as last summer in terms of new deals.
We've been really busy. We've always been, Ryan knows, we've always been busy as a fund. This year we'll probably do more like 50 investments in terms of net new, not including follow-ons. I think what really happened is venture capitalists figured out how to close deals on Zoom. And I don't think that's going to go away. I don't think people are going to say, well, we learned how to do it, so now let's not do it. But I do think people are going to take real vacation this summer because they were denied that for so long. So my expectation is that like deals will still get done this summer, probably at a less aggressive pace than last summer, but at a significantly greater pace than historical. And I guess what I've seen is, I was just joking with one of my investors this morning. I feel like a $2 million is the new $1 million. Like every company I meet right now wants to raise $2 million. I don't know how that happened, but that's sort of the new baseline ask. And so I think everyone is still very much in the realm of like figuring it out, particularly as things reopen and the ability to meet people in person is back on the table.
Yeah, Ryan, maybe chime in here. I'm curious kind of what you're seeing too.
Yeah, Natasha, I would echo what Charles alluded to, and I'm going to sit in a unique position because I'm privy to talk to so many other managers, and so I'm always constantly gathering information and intel from all those different managers. We have 25 managers that we currently invest with, and on top of, I think we have 700 plus managers in our database, and so I think that that's been a consistent theme that we're hearing. One, as Charles alluded to, people are going to take vacations, but when they do take the vacations, unlike completely detaching, their ability to still communicate, still connect, and maybe still get a few deals done over Zoom. I think that we're going to see that. I think people are going to be a lot more thoughtful about their pacing. I think a number of managers are looking at the aggressive pacing that they have been exposed to over the last 12 months. And so they're rethinking where they are in their portfolios, they're rethinking of when they're going to have to raise their next funds. And so at least as an LP, I think we're seeing things taper down a little bit. That said, the other thing that I've noticed is the amount of deal opportunities that spigot has opened up because of what Charles alluded to, the fact that you can do things over Zoom so easily now, or any screen so easily. GPs are seeing way more deals than they've ever imagined that they could, and really convincing people to buy into their secret sauce and give them the ability to allocate to them. So we'll see how that plays out moving forward. I think that it will be the norm and a consistent part of how funds and managers continue to allocate and identify companies that they want to invest in. So.
Yeah, no, that's great. I think, Gail, Eric, and Cheryl, you all are actually in different areas completely. Does anyone disagree with the fact that the summer is going to be, busy as heck?
I think on our end, it's definitely going to continue to ramp up. So I'm kind of in a weird middle ground between startup and VC, right? Where VC kind of just tech enabled, if you think about it. And we have benefited from COVID by 4 different trends, right? There's now this ownership economy where people just don't want to be consumers. They want to be owners of the products that they buy and, use every day. There's also founders who are starting to realize that community is key as a defensible moat. And so therefore they want to engage their communities early. There's the third one, which is more around alternative assets, and NFT and crypto is all starting to blow up. And last but not least is the fact that people are trying to diversify their portfolios. So instead of putting their money in the public markets, this kangaroo market, as people call it, and, now they want to diversify and put it into private markets. And so because all of those trends came into fruition, we saw an onslaught of deal flow, especially as Silicon Valley slowed down in investments for a while. Everyone came to us and as alternative funding source, right? And so from there, we've been trying to deal and trying to make sure that we're still a curated platform, right? 3% of companies that apply end up launching. But at the same time, we're increasing the amount that we have on any given day. So if you actually go on Republic right now, you'll see 100 types of companies at all different stages. 30% are generally bootstrapped. As you know, diversity, we're intentional about diversity. So 40% are women-led startups, about 20% are Black and Latinx. And by the way, that dipped for a while, but we made sure through our venture partner program that we were able to start sourcing for more. And so that actually went back up, which was really great to see, because especially during COVID, you saw the stats, funding for those groups went down. And so we made sure that we were able to capitalize on that opportunity. And so we're just continuing to see, we're crushing our OKRs in terms of the amount of deals that we're seeing, the amount of high caliber post-product, post-revenue, doing more quite frankly, we saw one doing more than 11 million in revenue. There's a whole gamut of companies that are still looking to take this opportunity for the summer to do these marketing growth hacks, to build their community, to take while everyone else is asleep. We're out here grinding, I think that's kind of why, Republic is so incredible, is that you can actually do it when you're raising, when you're not raising, and just in different capacities so that you can make the most of it. So I think that's something that I'm really looking forward to. And I am looking forward to a vacation. I just don't know when. So we'll see though. Hopefully it will happen. Just
I know, that's common. I know, it's so hard. You look up and it's been 2 years. No, but Cheryl, I think you touched on something important, which was the diversity and the impact of investing in diverse founders during the pandemic. We saw the pullback during Zoom investing as kind of that main way people cut deals, disproportionately hurting female founders, Black founders, any founder from a minority group. And so as things ramp up, things start to sprinkle in person, do you think that we're seeing things get easier, dare I say, for underrepresented founders? Or are we still trying to figure out new ways to convince and show the importance of it?
Back to me or someone else?
Yeah.
Yeah. I mean, well, I was able to go to my first real tech event with 200 people this week, which was crazy to me, by the way. Total real adjustment. I think you all will have that experience. But somebody came up to me and was like, Republic went from being in no conversation to every single conversation, and especially with underrepresented founders, right? And I believe that during the pandemic, it was a time of crisis, but it was also a time of opportunity. And so we were invited to every single event that had to do with underrepresented founders, whatever, because people knew that we didn't just talk the talk, but we walked the walk, and we were able to prove that through our portfolio, these are how many people we've been able to support. And with 33 states are represented. So it's not just diversity in, ethnic or racial, but it's also geographical, right? And so that's something where we had a concerted effort to go to Atlanta, Detroit, LA, Portland, before we went, before the world went under. And so because we were able to show that we were truthful and talking the talk, then we were invited to all these events. And so I did, I think 60 events Q1 or Q2 of 2020. And so through that has just spread word of mouth. And so now every single time people now see Republic as the tool in the capital continuum, which I think is really awesome, because especially when VCs say they're doing stuff and they're not really, then, this is something where we can continue to go back and say, this is our core, this is part of our DNA, and we'll continue to do so. We just created a venture partner program, which I started about a year ago, which now has 140 VCs, accelerators, ecosystem players. And the reason why I started it was because it's kind of my network, quite frankly, and because I'm, Latina, I'm diverse, a lot of them are diverse. And then through that, they've been also referring diverse founders. So as I mentioned, 65% of our pipeline right now is underrepresented folks. And that to me is one of those kind of scalable systemic solutions that we did that would allow us to, as we continue to grow and scale, and there's more pressure to move upstream, right? our investor base is like, we actually want like seed, Series A, Series B companies that we know, and we want the brand and all that. And it's like, that's great, y'all, but we also need to support pre-seed, and those that, underrepresented founders for the most part need it on the pre-seed side. So like, there's really this balance. And so making sure that we have a good funnel and people that are supportive, the OGs who believed in Republic from day one, versus now, there's a lot of people coming back and being like, how can we partner? And I'm like, y'all weren't with us, in the gym. So like now we're out here, like, how do we best capitalize and reward those people who also were believers in us from the beginning?
Yeah, Gail, I mean, generally speaking, where are you seeing, are you seeing things get like about to change for the kind of pullback and disproportionate lack of funding for underrepresented founders as things start to reopen, reheat back up? Or I guess they never stopped heating up, but you know what I mean?
Yeah. So I think that the biggest trend that is a positive right now for underrepresented founders is the fact that we have a lot more emerging managers with diverse backgrounds raising funds. So at the really early stage, we have to get more checks into founders' hands, which is actually happening, but because there's like these really massive mega rounds that are largely going to white male founders, it's skewing the total venture dollars such that it looks like it's getting worse for diverse founders. But if you look at the really early stage, it's getting better, and we can help it get even better if we continue to fund emerging managers who are interested in giving dollars to underrepresented founders. I think that's the number one thing that we have to do.
Yeah, Eric, would you say that kind of matches with what you're seeing in your area of the world? Just an increase of emerging fund managers kind of everywhere you look? It's what it feels like on Twitter, but I'm curious what it feels like for you.
That's correct. So the Africa story is a little bit in the sense that the African investment ecosystem is heavy on private equity. So 20 billion plus raised in private equity. A lot of the big private equity shops, Carlyle, KKR, Blackstone, all rushed to Africa. And then they realized that, they didn't realize, but they kind of had the rude awakening that there were very few deals that they could invest in. And so they were now competing with the DFI, the Development Financing Institution, who had also backed some of the PE funds. And actually, one of our LPs decided to invest in our current fund because they started realizing that there were 3 in for every deal that was in private equity. And so it became a beauty contest in private equity. And so you've had the KKRs, fold back, Carlyle is folded back, Blackstone is folded back. And the story there is that Africa is not working. And I take a different opinion on that. I think it's because there was just too much capital that went into private equity, and there were very few deals. And the reason there were few deals is because there's not a venture capital ecosystem or investment band, whilst angel investing is picking up. And that's why we are trying to bridge that gap. And so with our new fund, the strategy is to take companies that have raised seed funding and are doing okay, and then give them venture and growth so that they can be big enough for the private equity funds to take them from us. And I think that opportunity is going to be around for a while. Actually accelerated by the COVID situation. So sort of going back to sort of your first question, what happened in Africa when COVID hit was there was a pause because everybody, people didn't anticipate it. Actually, I was in South Africa and I was on the last flight I got into Accra before the borders were shut. Otherwise, I'd have to be in South Africa without my family, right? So everybody kind of took a pause. And everybody started sort of taking, doing an analysis of their portfolio. At least that's what we did. And one of the things that we realized from our portfolio that we had sort of 3 types of companies. We had what we call mobility businesses, which is businesses that work because people have to be mobile, right? So travel tech, we had 2 travel tech in our portfolio. And then we realized that we had other businesses, we had what we called virtualized businesses, which is businesses that take people online, free to work. And then between that is what we call the semi-virtualized business, so e-commerce and that type of stuff. Now, mobility businesses were really hit, and one of our companies, Hotel Online, we had to come up with a totally different business model, which was quite an interesting exercise for us to do as the fund together with the partners. And then the virtualized businesses were just on this upswing, right? The net, the virtualized businesses really took off. a lot of people went online because, as you know, Africa really had a street lockdown. So Ghana, I couldn't go out for 2 months. So, everything had to be online. So that really drove, sped up the digital economy. So a lot of the virtual businesses and semi-virtualized businesses, essential services, really got a leg up. Actually, one of our portfolio companies started a food delivery business that we were hoping to start next year but we had to start it during COVID because everybody wanted food delivered to them, and then the whole thing just went, straight up. So, so net in Africa, COVID turned out to be a positive, in the sense of tech investing, and VC investing. Having said that, I think that there is sort of a counterintuitive narrative in the sense that because economies in Africa were shut down, people's purchasing power went down, right? But people were purchasing online, which is in some sense relatively cheaper than if you have to get in a car, go to a place, and all that type of stuff, right? So whilst purchasing power went down, a lot of consumption went online. So for example, in Ghana, we had 100 $100 billion in online transactions. I may be getting the number right. Our central bank just announced that. And I also went to my first physical event this past Monday, the Ghana CEO Summit. So I went and spoke, and our vice president was there, all the captain of industries. So my first time, meeting people, and, the central bank, I think it says 100 billion. But imagine that in 1 year, 100 billion worth of transactions all over mobile money, not over the banking system. Whilst the banking system did probably something like, was it 100 million or something? It was kind of a crazy number. And this was not just Ghana, it was Nigeria and all over the continent.
Yeah, I think what you're illustrating too is between the companies that got that really, it sounds weird to say, but like fortuitous pandemic bump, and the ones that didn't. And I feel like the ones that did are where a lot of the attention is right now. But I am curious, like on a sector by sector basis, where everyone's at right now on what's hot and what's not. And I know these things.
Natasha.
Yes, Ryan.
No, I thought it was just interesting as I was sitting here listening to Gail and Cheryl and Eric and Charles speak and yourself. When I'm looking at this panel, this is amazing. When we think about where venture is going over the long term, my hope is it's these types of panels that become the norm. You think about the diversity that's represented here. You think about the different perspectives and different strategies that are represented here, all of which have the ability to win and put points on the board and are very unique. And I thought what Gail mentioned is if we can find ways to create more diversity in terms of those individuals allocating, I'm sure we're going to continue to support men and women that are in essence underrepresented, but really technically are not underrepresented in my community, because my community, I'm pretty engaged with them. And so, Charles, I'm curious for you, when I think about how long you've been in the game and how well respected you are, I know you don't have a mandate to focus on underrepresented founders, yet I'm sure in your portfolio, it's reflected in the community and the individuals that you serve and who you network with. And how do you wrestle with that focus and trying to lean in, just focusing on the talent versus maybe, trying to invest with people that look like you?
I think when we started the fund, I'd been a partner at a bigger seed fund for 5 years, and I felt like there were parts of seed financing that actually worked pretty well. I was like, if you're a well-networked founder or repeat founder, the current seed ecosystem works great for you. You're going to raise a lot of money on a very high valuation with basically no proof. It works great for you. It doesn't work for you kind of at all, was sort of the operating thesis I had when I started the fund. And so I went into that thinking like, okay, well, there's probably lots of people for whom it doesn't work well. If we focus on the people that are not well served by the seed ecosystem today, and I think it's even more was when I started the fund, that so much of the dollars are going to really talented, and this is not to take anything away from them, really talented, really experienced repeat founders or people who are leaving companies where VCs know how to evaluate what it means to be from Uber, what it means to be from Stripe, what it means to be from Pinterest, et cetera, et cetera. And I just felt like, well, who's on the outside? Well, it's women, people of color, people who's like, for some reason, their background's different. So I was like, well, we ought to end up with the portfolio that looks really different, even if it's not explicit, because the people we're targeting are the ones who aren't being served. And the thing that's been shocking to me is my original thought was, well, I'm going to have to go to the ends of the earth to find people. And it turns out there's actually, this is to me the biggest, most shocking irony of the whole thing. There's a ton of underserved, unnetworked people, even in Silicon Valley. Even as much as we talk about the coastal concentration of venture capital, there's a lot of people, I know it sounds hard to believe, there's a lot of people in San Francisco who are mid-level product managers at companies. They don't know any VCs. They don't know how to raise money. They don't have anyone in their network who's raised money. They're too busy just trying to do their day job, and they go to start a company. And so the surprising thing for me is that even within some of the more established venture hubs, there's still large pockets of people. Like I think about someone who I know, Natasha, like you all at Crunchbase have written about. Think about someone like Shannon at Noyo, who was working at Zenefits with her co-founder Dennis, and like super talented founder, but hadn't been a founder before. And she was like here in the middle of all of this. And I think the $1 million and change that she raised in her pre-seed round made a big difference in her ability to sort of get that company off the ground. And now it's one of the ones in our portfolio that I'm like most excited about. But I didn't anticipate that there could be people that were like physically so close to capital, but in reality also like virtually really far away from it in terms of their ability to like build relationships or get access to people. And the other thing I'd say to Ryan's point is we've tried really hard to be open to everyone. It creates a lot of pressure on the firm to get back to people, but we try to say like, you don't need to be triple referred in to us for us to take a meeting. Like it shouldn't be that way. And I think the industry is slowly, not everyone, but large pockets of the industry are slowly moving in the direction that like, hey, this sort of limited accessibility is great for managing your calendar, but not necessarily great for finding the best opportunities. So, you know, in venture things change slowly and then all at once. And so I think we're in the middle of one of those phases, but I've been really surprised at how many underserved people there are, even in sort of capital dense markets like the Bay Area and New York, and LA in particular.
Yeah, I mean, let me ask, do you think in that way Zoom investing was a net positive for underrepresented founders, even the ones that were in your backyard in some ways?
I think thing is going to have the most net positive impact on founders who don't want to live in the Bay Area, New York for lifestyle or personal reasons. I think Zoom investing is going to have a huge impact on Atlanta. I personally think Atlanta is going to be by far and away the principal beneficiary because there's a lot of Black and brown people that like living in Atlanta and do not want to live in San Francisco. They just don't want to do it. And now they don't have to. And so I think there are like geographic pockets of like talent density where before it was kind of like you have to pick one of these two really large coastal enclaves and you have to pick one, you have to move there so that you're close to your investors. I think that's not going to happen as much. I think there are tremendous benefits to being in dense ecosystems, but I really think this is going to unlock a lot of value for Atlanta. And I think it's not going to be because a ton of VCs move to Atlanta. It's going to be because Atlanta-based founders have more access to venture capitalists around the country.
Gail, and you're based in Chicago. How much are you paying attention to startups not in Chicago?
I do a little bit here in Chicago and then also elsewhere. So I think it's an interesting mix of having a mindset where, you know, we're an hour and 20-minute flight to Atlanta, other markets that have really interesting up and coming startup ecosystems like Tulsa, Oklahoma is one. But then also we have a team member that's in San Francisco and one that's in LA, because if you just look at those ecosystems, they're fantastic. And in our portfolio, we want to have access to a little bit of both. So it goes well in today's remote world, right? We've got a team all over the place. We've always been comfortable with Zoom. We're doubling down on it, and we're figuring out additional ways that we can both provide our team with support, but also our founders that are really all over the country now.
Great. Yeah, I think like we're all talking to about like broader decentralization of venture capital, even from the capital sources themselves. I think we all know the phrase democratization of venture capital and all have thoughts on it. and how accurate it is and how close we are to a world where democratized VC is a possibility. And Cheryl, I know you'll have thoughts on this, but I'll let a VC take it first, and then I'll toss for the Republic angle, because I think that'll be a really fun complement. Maybe Ryan, give me your thoughts on what opportunities, that long-term opportunities there are for founders as we see venture capital get more and more unbundled.
Yeah, it's an interesting question, and I think about the analogy I'll use, because I'm clearly a sports guy. You think about college football, and you think about Alabama, and you think about Alabama's success year in and year out, and their ability to recruit the very best young, talented men in high school. Every single year, they have 5-star, 4-star recruits, and they have built an unbelievable moat, but they've built a recipe of success. They have built a brand. They have built a system that if you're a young man that wants to make it to the NFL, they're probably going to give you one of the best opportunities to do that. And there are a number of other universities. I'm a Bruin, UCLA, so I would put them up in there. I'm clearly biased. But you think about that, and there's over 300 plus universities around the country that also have football programs, that also have young men that are going to play the game and trying to compete and probably have dreams and hopes of being in the NFL. And you're starting to see the NFL players start to come from some of these other programs, because the NFL themselves has built the system to do whatever they can to scour the entire country, the entire globe, to find the best men that are able to compete at the highest level. I say all that because I see that happening now in venture. Clearly, Sequoia is going to continue to be Sequoia because they have built a phenomenal brand. They have an unfair advantage because of their success and their ability to provide potential customers to others. I would argue that they are the Alabama in this kind of analogy. That said, there are a number of other great VCs around the country that are starting to identify and produce talent that have the ability to scale and put points on the board. And I think that's one of the things that's so interesting is now founders have optionality. They have the ability to think about taking money from other industries or other individuals that they may relate to, that may have specific expertise, or individuals that they know that can be in their corner, that are going to fight with them and be with them from start to finish. And so that optionality is going to be, to me, contagious. And I think, again, we talked about this, the ability to continue to provide a diverse perspective and unique experience to help relate and connect, which I think is a really important trait that a manager has to have, is their ability to relate and connect with that founder to win the opportunity to invest. We're starting to see that change. And so as I look at it moving forward, we're going to continue to see great companies started all over the place. Charles alluded to Atlanta. We're going to start to see other areas like Salt Lake City and Austin, and we all know what's going on down in Miami. But you can think about Tampa and Tulsa and some of these other true sharing markets because of the optionality these founders have to take capital from VCs all over now.
Cheryl, I wanted to ask you too. I mean, I think Republic, for anyone listening in who may not know, Republic became even more interesting just a few months ago when the equity crowdfunding rule increased and allowed founders to raise up to $5 million in equity from retail investors. Correct me if I'm wrong. I believe both accredited and unaccredited investors. Yeah. And so Republic is one of the places where a founder can go and basically ask their community to back their company, basically circumventing the traditional venture capital for those first 5 million. And so Cheryl, one question I had for you was, when founders are thinking about this, because this is a choice that they'll have to live with, throughout the lifetime of their company. What are the, things people should think about before turning to equity crowdfunding? I'm sure it's more complicated than just, let's try and raise 5 million and, pick a site. So what are some of the,
I have so many things I want to touch on. It's kind of crazy. So I'm gonna actually just start once again with let me start with just democratization of venture capital right now, then go into your question, and then also talk a little bit about how we can all do our part, right? So let me start with the democratization of venture capital, right? We see more and more funds popping up. We see, more underrepresented managers coming up. But to be honest, if you really think about that model, it's just going to continue to increase. Like everyone's raising a fund right now. It's kind of crazy. Like people even with no track records too out here just making, the stone soup fable at all. I feel like this is a stone soup. Like just check it out. But like that's literally what I feel like. And so people say that's democratization, but then again, like where does this stop? Right? I feel like it's just going to be a huge washout period over the next 10 years because to be honest, most VC firms don't have many vintages, quite frankly. Like the ones that last are the ones that understand the game, right? And so to be honest, like do we want to just keep getting VCs to proliferate over or what's the future? And that's what I think, like, I took a pay cut from banking to come to Republic because I thought that this was the way, because there's power in numbers, right? And so I think that is key, is that anybody can be a VC in the sense of using their knowledge, their expertise, being in their industry is like, oh, I was in the trucking industry and I see that this is a major problem and this person is raising, 5 million, like, let me go put some money in, right? And that's the thing that I think is so important, is that drops fill the bucket and we can't ignore that. And so to be honest, what's happening with VC is starting to like what's happening with Republic, except that we're exponentially increased and we have 1 million people on our platform and we're going to continue to increase, right? That awareness and education around investing. Going to your question now around what should founders think about, just to clarify your point though, it's not the first 5. Actually, a lot of the Series B and C companies that are about to go on the platform are doing this more as a marketing growth hack. They're using it as a way to give 5 million of equity to their customers. And think about Airbnb. Had they done it early for superhosts, that would have been a whole PR thing. You understand? Like they would have talked and walked the walk. They had to do it like the very end, and it was kind of seemed less proactive and more reactive. And that's the thing where you're building community, trust and brand is everything. So how do you go and build that? So to the founder's point, a lot of things we get set is like the cap table. Is the cap table going to have 5,000 people? The answer is no. We use the crowd safe. I can go into that later. Is this going to be a headache or is this going to deter me from VCs? No, we literally had 20 million, ACCC led the round for Maven, right? We have one coming up from Sequoia. We have all of these, I believe VCs are starting to see that it's not a deterrent for them as long as they're a good company. And once again, we're a curated platform. We are the gold standard in this, and therefore that's not going to happen. And last but not least, it's like, well, do I just put it up? Once I go, like, is it just like I put it up and y'all fill this? The answer to that is no. It's a partnership. We have 1 million people, so we can bring in. You also bring in your community. We fill about like 60, 80%, depending on the offering. And people are just like, oh, it's only consumer companies. But no, actually, more B2B companies have raised the limit than B2C. And the reason why is because investors are more sophisticated than we give them credit for. And so I think that's why they see it as an investment, and not just, here I can get I can be a consumer of this. And the last thing I'd say is that I think Eric and I, correct me if I'm wrong, but we're both from Harvard. Charles is from Stanford, and we have, I know Gail and Ryan, but like, I feel like we are amazing in our own right, but we had to go to these elite institutions to be considered and be here right now, right? And I think that's all helped us to such degrees in terms of building these doors. I'd say that we are, helping and supporting more underrepresented founders. And I mean, to be honest, if I wasn't at Republic, I'm not sure if we would have been as intentional about making sure that we reached out, but we are all leaning in. And I'd say that our next step is also making sure that we're getting more VCs that are not necessarily from these backgrounds to be in this space, right? So I created something called VC Familia, which is a collective community of Latinx VCs. There's about 150 now, super exciting. We're growing, and it's only been 4 months, right? But people, if I ask Charles right now, how many Latinx VCs do you know? You would maybe count them with 1 hand, 2 hands. And so there's a lot, there's a lot more out there, right? And so that's why we're building this all together, sure, so that we can support each other, mentor each other, and get more. And so we've already gotten 2 people so far into VC with the Latinas, which is really exciting, and hopefully there'll be more.
Awesome. That's awesome. And I mean, I guess I do want to get into a little bit of like, maybe like the tactical things that founders should think about when still choosing to go through one of the many other ways to raise capital, simply because even though it can be a PR stunt or marketing growth hack, it is still equity at the end of the day that they're giving up. It is still, just a spot and money for someone else and a user that they have a new responsibility to. And so it feels like a big deal to me, but I'm curious, like maybe Gail or Charles chiming in here to tell me, as you guys are probably seeing the founders that have raised through Republic, get pitched to you. What are your reactions when you see a founder that has, you know, not a completely empty pre-funding history before reaching out to you? Deal breaker, deal maker, any thoughts there?
So I personally am long on crowdfunding. I think that there's some others. I think that VCs are working more closely with crowdfunding platforms because it just makes sense. Community is important, branding is important, ensuring that we're leveraging technology a little bit smarter than we have in VC in the past, and crowdfunding answers a lot of that. And with the increased regulation, like, it just makes sense. And just so you guys know, we've been looking at this at Vitalize, and I can share some data from founder interviews that we did. We asked them, do you guys care about signaling? Do you care about the extra financials and Form C you have to fill out? What do you care about and not care about? And what we found was interesting. The only thing that they really care about is the 6 to 8% fee. And almost all of them don't want that. They could care less about the rest of it, which is really interesting, because I was worried about, do you care about signaling and all these things? But at the end of the day, we have to figure out the fee, and like resetting that perspective with founders. Once we figure that out, I think crowdfunding opens up tons of doors at the early stage.
The thing I'd also add is my general view is venture capital changes when founders want it to change, not when VCs want it to change. Like, that's just like, I don't think any VCs wanted safes to happen. None I know, but like, founders wanted safes to happen, so safes happened. I actually think to me, the thing I spend the most time thinking about is the impact that operator angels are having on the venture ecosystem. Because I think whether you bundle them all together and bring them in a collective vehicle on Republic, or you let them in one at a time, I think operator angels, at least in my universe, are eating up a lot of the non-lead allocation in the best rounds that we're a part of. And I think it's actually a good thing for most founders. For the next venture capitalist you have, it's good to have some of that perspective, but you've got 4 of them. Like, what is the 4th person probably adding in terms of perspective? Even if I'm the 4th person, like what are you adding relative to what you're already getting on the cap table? Whereas a bunch of individual operator angels, they're current with what's happening in the market. They oftentimes are empathetic and sympathetic to your situation. They can write small checks, and oftentimes it's not their money. They're either a scout or they're a proxy for someone else. But I think, like a lot of the $1 million rounds we do, a quarter of the round is coming from some collection of operator angels, either that invest together as a group or that were individually selected. And it could be, CEOs of really adjacent relevant companies. And I think that's here to stay. Not only is it here to stay, I think it's going to become a bigger chunk of cap tables, because I think the founders I work with get a lot of value out of having those people. Now, eventually those operator angels will become overburdened as their portfolios get to be too large, and the cycle will begin again, as it always happens. But I think in the medium term, that's the thing I think is going to put the most pressure on venture, is these operator angels that used to write a 10K check can now write a 25K check, can now write a 50K check. And soon you're going to have ones that can write significant checks and can be maybe even basically virtually lead these rounds. So I think that, to me, is the thing that I spend the most time on. I think the crowdfunding, the thing, like that's not going anywhere. That's here. And it's a great way to Cheryl's point, to engage your community and your earlier supporters.
Great. Kind of on the opposite end of small operator and angels, we have to talk about Tiger Global and how much attention everyone is paying to it, and how much it is making your days every single day to see it lead all the rounds. Eric, maybe we can start with you. How is Tiger Global impacting your day-to-day at all? I mean, its investment cadence has obviously become a sort of joke, but it is real. They're sending hundreds of millions of dollars out there. How much are you paying attention to them, and how competitive is it getting for you?
Well, I mean, Tiger Global was active in Africa in 2017 when about 150 million. I think they had a flat round of 170 million at $1 billion valuation. Now, the Tiger Global move, I think that it's unique to Tiger Global in the sense that if you realize that Tiger Global, its own LP, majority of from themselves, right? So they can move at that blaze scale and try to deploy capital. But I think that there's a downside to that. And that downside speaks to what is going to differentiate GPs when everybody has access to the same amount of capital. And I think that to Charles's point, operating experience, in my view, is going to be the differentiator in venture capital as we go into the future. Is that capital is going to be, in the manner of speaking, like talent available. And so the differentiators will be those who can add value. And here, operating experience of value add is very broad, right? So in Chanzo, we say that we provide the 3 C's that entrepreneurs need to succeed. It's capital, capacity, and community. And that came clear when COVID hit, because for a lot of our portfolio companies, though they needed capital, they needed capacity and community as well. And because we had that as a firm, we were able to offer that. And I think that this is going to be a differentiating factor going forward. The second is that I think you are going to begin to see that because of the failure of WeWork and the challenges that people are now seeing with the whole blitzscaling model, founders are started begin to think about being profitable, building businesses that have strong unit economics, and that is going to give the leverage back to founders. Because currently, I think the VC model thrives on the fact that leverage is with the providers of capital. But the reality is that the leverage is with the entrepreneurs. And I think Charles alluded to that a little bit in his earlier part of his comment. So we are building into that future. And in Africa, this is even more important. Part of it is that currently in Africa, you don't have a lot of capital, right? So if you are a GP, you need to be able to take a little bit of capital and let it go very far. That means that if you have operating experience, you've been able to run a business before, you know how to get the founders very quickly to profitability so that they depend less on you. And founders are beginning to think like that we need to depend less on VCs, but more on our customers. And so as that move begins to happen, the leverage that VCs have begins to decline if you are just the provider of capital.
Yeah, I mean, I think that you're getting at something really key. And I think that it is something I've heard from other VCs I've talked to, which is like founders have the option and they have the power to choose between Tiger Global or the smaller pre-seed firm. And it kind of comes down to what they are, what their goals are and what their priorities are. But I guess I am wondering, like, in terms of competition, like how everyone's, I guess, feeling. And if you guys do think we're going to be talking about these mega funds 10 years from now, or if you think that this is kind of like a momentary spike of aggressive interest. Anyone feel free to chime in there.
No one rush. Like, I would say clearly. No, I would just say like there's a whole barbell right here that, I mean, I'm just trying to summarize it. Basically, it's like you deploy capital really fast and like basically to seasoned operators like, Tiger is doing, where, they just already know what they're doing. They don't really need help. They just need growth capital to grow. So they'll do it the same day, right? Like that's that speed and velocity and just get out of the way, right? So didn't they deploy like 16 billion or something, or like some billions in 16 weeks or something like that? Like it was a crazy amount. Versus, and then there's going to be like on the other side of the spectrum, the very specialist, smaller VCs that like can help in some way, shape or form. And there's going to be all of those in the middle. Like there's some network or some way, like it's just gonna be a huge chunk of those that can't really move that fast, but then also like, don't necessarily have the biggest value add. They're just kind of like plankton with a whale, just kind of like along for the ride where they can plug in. And so I think that's where you're going to start to see this kind of divide in terms of VCs understanding like where their place is. And so Tiger and SoftBank are really kind of moving, shifting kind of the gravitational force more towards the velocity versus the specialization, and then everyone else in the middle needs to find another way to move.
Hey, Natasha, just to piggyback off of what Cheryl just mentioned, I mean, the reality is Tiger clearly has been spending a lot of time and energy and effort to identify the companies that they wanted to lean into. These aren't companies that just popped up overnight and all of a sudden are getting stroking big checks into. And so the fact of the matter is, they get paid too, right? And they got very talented teams of men and women that are going out there and have spent the time and energy to identify these crop of companies that they believe have the ability to generate a return based off of what their return expectations are, right? Their return expectations are completely different than Charles or Cheryl's or Gail's or Eric's. I promise you that. And the way that they're approaching the space, they get a tremendous amount of headlines about because of the dollars they're putting to work and because of the companies that they're going in. But the fact of the matter is, we could all of us could probably spend the time identifying the type of companies at the later stage that we'd want to lean into. The question is whether we'd have the capital to really put to work to compete alongside those folks.
And Natasha, I mean, I think it's also just worth remembering 4 or 5 years ago, like $1 billion valuation was a big deal. It didn't happen that often. It was like a big deal. And that was like the ceiling of what you could do as a private company. Like going beyond that, that's like the public markets won't support it. It's not responsible. And now $1 billion, I'm sure you get pitched all the time on $1 billion funds. Like, another one of these.
I know. They're no longer coverable. They're not all of them, at least.
You can't. That's like, think about what that says about our industry. That like $1 billion valuation is no longer an automatically de facto noteworthy story. Says a lot about where we are. And I think the thing I think about a lot as an early stage manager is that the people that sit on top of me, seed investors, Series A investors, growth stage, they're managing more money than they've ever had access to in their entire basically lives. And their returns expectations haven't gone down just because they have more money, which means that you end up in this world where the companies that feel like they can be decacorns or whatever's bigger than that, centacorns, like those companies get a disproportionate amount of attention and capital because the impact one of those can have on your fund is like out of this world. And so I think we're going to continue to see this skewing, as long as it's competitive, towards people wanting to get in on those companies. And if you think about it, for some of these companies, everyone's like, wow, they tripled their valuation in 6 months. I'm like, yeah, they went from 1 to 3 billion. If it's a $10 billion company, the person who put in at 3 is still going to do fine. Like, they're still going to do fine. But more importantly, the person needs a $10 billion outcome to make their fund math work. And so we're in this weird cycle where more money in venture means you need more exits, but the public markets to date have been relatively friendly to producing said more exits, which means you get more money in venture capital, and that feedback loop continues until it breaks.
By the way, Charles, Africa valuation is a big deal, and I wrote about that in my blog post that I keep on my Harvard platform. So we are probably where you were many years ago. So maybe there's something to be said for that. But we also notice a second trend in Africa, which is sort of the first sort of the unicornization, which is mostly adapt to fintech. And I'll try and answer the question that came in the chat. That in Africa, sort of the area, the segment that is getting attention is fintech, right? So, well, mobile money it's a phenomenon that came out of Africa and it's become a global thing. And so most of the unicorns are in the fintech space. And the second trend that we're observing in that space, which is sort of coming to maturation, is mergers and acquisitions. So Stripe, came into the market by buying Paystack from Nigeria, and we think that Flutterwave may get bought next very soon. But someone's coming to Africa, and I think that we're going to see this. But we also see a second trend, which is that bigger, earlier stage fintech companies are, acquiring earlier stage fintech companies in Africa to land grab, right? And then there's a third, which is that the big banks, some of the big banks, have woke up to the reality that if they are not careful, one day these startups will eat their breakfast, lunch, and dinner. So some of them have started creating VC arms, incubation programs, and basically getting their feet wet, and then some of them have actually started doing acquisition. As a matter of fact, FNB in South Africa's biggest and most innovative bank, just bought Staples, which is a township startup that had many accounts in the township area, and they just bought them 100%. And then there's sort of a phenomenon that is happening in Nigeria, which is kind of a little bit the exact opposite of what you're seeing in South Africa, where the banks have woken up to this reality. But in Nigeria, the banks are still fighting it, with the regulator on their side. And so, for example, MTN Money and Airtel Money cannot get a license to provide, banking services on their Momo platform in Nigeria, right? And to that, I say maybe these fintechs will end up buying the banks. And interestingly, Branch already did that in Kenya, where they just acquired 85% of a micro finance bank in Kenya in order to get the license and get into the space. So things could get very interesting in Africa very quickly.
We only have a few minutes left, so I wanted to end with a fun, light question, which is, what is one, I guess, non-obvious sector that you would back or make an investment in, other than the top 5 that are right now? So what's one sector that's gotten you really interested and excited recently that if you could and you found the perfect company, you'd write a check in right now? I'll start with you, Eric, and then we can do Cheryl, Gail, Ryan, and Charles.
Well, our portfolio still have fintech and e-commerce, still the top spot, and we're actually now doing. We're just in the process of concluding a crypto investment that we're making that is in the fintech space. So, but in Africa, we think that there is what we call internally second level innovation in fintech, which is that you're not going to see applications that sit on top of mobile money, right? And you're going to see people building things like peer-to-peer lending, so crypto type platforms are going to start emerging that combine crypto, mobile money in interesting ways. For example, the company we're investing in is using that to do cross-border transfer, for example. So you're going to see some of this stuff. So that's an area that we still think there's a lot of interest. And then, courtesy of COVID, digital health has now become another interesting area. That we have not succeeded. We've done 2 of our investment that failed was in that area, but one of them resurrected during COVID, and now we begin to say maybe this is the time to pay attention to it. So maybe health tech becomes sexy again, maybe not.
Thanks, Eric. Yeah, Gail, let me know what you think. Or Cheryl, sorry, and then Gail.
Sorry, it's all good. I'm very focused on femtech and silver tech, so improving women's lives and then improving the lives of the elderly, the quality of life, right? Because I'm sure, I don't know, but I feel like I aged 5 years in pandemic. So like, my knees are cracking. I'm out here, taking an hour to get out of bed. Like it's hard. And so, but people just don't realize, or they just don't think about what's up 30 years ahead when we're all dealing with different things. And so I'd say the intersection between femtech and silver tech is menopause, and really helping and supporting how, women specifically transition through to the next phase of their life is a huge opportunity that not many people are looking at. And so it's something that, affects 50% of the population, and so that's something that I would be bullish on.
I think that EdTech's time is finally here. So a lot of cities have lost a lot of money in the space, and we've got a killer EdTech company in our portfolio, and even with great numbers, they still had trouble fundraising over the last few years. But I think we're finally seeing the tide shift on that, and it's because of the world that we live in, and administrators and teachers have to get on board with technology. Which is a really great time. So we're bullish on figuring out the intersection of future of learning and work and ed tech and what kind of cool innovation can come there.
Gail, like ed tech too. I think it's exciting. It's growing, but specifically more personally for me, it's around human optimization, really even more specifically around spiritually, mentally, physically, how we're all trying to optimize and what technology is going to allow us to achieve that better. And so, as Cheryl alluded to, many of us have recalibrated or trying to think about life later on and down the road, and COVID gave us an opportunity to reassess ourselves. And so I think coming out of this, it'll be really interesting to see how technology helps us all optimize our lives better.
We've just come back to good old-fashioned consumer applications. We've done a lot of investing in that category, and most of it, I don't think we've announced any of it, but we've done a lot of it in the last 24 months. I just feel like most of the apps people use are kind of long in the tooth, and behaviors have changed, and not all the apps have kept up with it. And so I feel like that's one of those categories where hope springs eternal every year. And we've been spending a lot of time there just trying to make sure we're staying on and seeing lots of cool things happen.
Great. Thank you all so much. I would try and summarize everything, but I feel like it was everywhere in a great way. But I think the TLDR is that there's a lot of hope and cautious optimism about where venture is 10 years from now, thanks to decentralization, thanks to Zoom investing, and thanks to different kinds of capital and emerging fund managers to think. Even though the data is out there that says that underrepresented founders are not getting as much money as other people out there, there is a lot of reasons to believe that is going to change. And agreed, Ryan, that I hope this panel becomes more of a normal. It was great. You guys were all lovely. And yeah, thanks so much. Enjoy the rest of the conference, everyone. Bye.
Have a great day.